I'd like to talk about performance evaluation. One of the main applications of financial theory is in the actual reward of managers or replacing of managers for performance or underperformance. Now, we've already developed the tools whereby we can go through and do a reasonable first cut at the performance evaluation problem. For example, one thing that we've looked at is something that's referred to as the Sharpe measure. Now, I didn't call it this before, but let me define the Sharpe measure as the expected excess return on a security or a portfolio divided by its volatility. Now, the Sharpe measure gives us a reward to risk ratio. However, let's be careful about what we refer to as risk. In the denominator of the Sharpe measure is the volatility of that particular asset or project. So in order for this to be risk, it must be the case that we're looking at projects that are mutually exclusive. That means you can either do one or the other, and we assume that you do not hold a diversified portfolio. So the Sharpe measure is only a valid measure of performance evaluation when we're talking about mutually exclusive situations. It's the expected excess return divided by the volatility. It's a simple measure to calculate, and you hear practitioners talking about Sharpe measures all the time. Of course, the major shortcoming with the Sharpe measure is that it looks at the volatility of the particular asset and refers to that as the risk. We could improve upon this particular measure by looking at a different type of performance evaluation measure, and that's what I want to do next. What we could do is to look at performance evaluation in the context of an asset pricing model. So the asset pricing model delivers a beta for the security or the portfolio, and there's a risk premium that's associated with the beta. We multiply the two together and we get the expected return on the project given the level of risk. Now, there's a realized return. We compare the realized return to the actual return, and we get a difference, which we can call the performance. If the realized return exceeds what was expected given the level of risk, then we say that this asset or this manager has performed better than expected given the level of risk. Sometimes we call this the alpha. And we always look for positive alpha. And sometimes people are kind of loose in talking about alpha, and they'll say, I'm an alpha manager. Well, I think it's better to be known as a positive alpha manager. You want to achieve a return over and above what's expected given the level of risk. So we're always looking for alpha. And the alpha concept was first introduced by Michael Jensen in his dissertation in 1969. And Jensen studied the performance of a number of mutual funds. And he measured their alphas. And in the lecture note, there's the original graph from Jensen's study. And he noticed that the performance of these mutual fund managers was less than distinguished. That most of the alphas were negative. A few were positive, but there was only one that was significantly positive in a statistical sense. Now, there's some other hybrid measures of performance. There's a measure that kind of looks like the Sharpe measure, and it's called the Trainer measure, named after Jack Trainer. And it is the expected excess return on the security divided by its beta. Now that actually makes a lot of sense, because remember we said that one of the problems with the Sharpe measure was that the denominator had a measure of risk that maybe wasn't the measure of risk we really wanted to consider, especially if we had a diversified portfolio. Well, this other measure divides by the beta, and that is the risk. That is the contribution of the security or the portfolio to the variance of a larger portfolio. So this measure makes a lot of sense. There's a lot of other measures that are detailed in the lecture notes, and I'll talk about one measure that has got some recent play, and actually I'm part of this measure, so it's a little embarrassing talking about it, but it's what's known as the, I guess now, is the Graham-Harvey measure. So let me talk about that. We can think about the Sharpe measure. Let's go back to the Sharpe measure in the following context. Think of the efficient frontier. And think of the tangency portfolio. And let's call that the Standard & Poor's 500 portfolio. And then we can connect a line from the risk-free rate to that market portfolio. And that is the market Sharpe ratio. It's the best possible Sharpe ratio that you can obtain, given that it's a tangency portfolio. It's best in the sense that it's got the highest possible slope. And the highest possible slope means that you get the maximum expected return per unit of risk. And risk in this context is the variance of the well-diversified portfolio. All of the efficient frontier portfolios are well-diversified. And we're getting the maximum reward per unit of risk. And this is exactly the ratio that goes into the capital asset pricing model. This is the way that beta is rewarded, in that we are assuming that people hold well-diversified portfolios. So the Sharpe ratio for the market is very important. Now, that said, if we look at Sharpe ratios for individual securities, I already mentioned that that this could be a little problematic, because we're looking at the variance as the risk. And it's possible that a number of these portfolios have Sharpe ratios that are less than the market Sharpe ratio. So Graham and I come along with the following idea. What we do is we say, okay, here's a security or a portfolio, and actually our application is a bunch of managers that are making recommendations for portfolios, investment newsletters. So we look at the recommendations and look at the portfolio that obtains from that. And that portfolio's got an expected return. That portfolio has got a variance or a standard deviation. So this is what we do. We form a portfolio of the market, a Standard & Poor's 500 or the Morgan Stanley World Portfolio, whatever you want to define as the market. But we form a portfolio that has got exactly the same volatility as the strategy that the manager is recommending. And that portfolio has got an expected return. Our manager has got some return that's realized. And we take the difference between the two returns. And we call that the Graham-Harvey measure 1.